All right, YouTube, back again with part 2 of the interview with Bruce Fraser. Hope you enjoy it.
So here, look, this was not the final high. The highest count I could get was 63,000. I think it went to what, 68 or something.
Yeah, right.
Yeah, and I was going to update that number. I didn't get to it today.
You know, there's an
And
element too, just to sprinkle this in with that 68,000. There's a way to view margin activity and options and that kind of thing. So anything that's borrowed money on the crypto scene, and it was at an all-time high by an order of magnitude compared to the years before, at that $70,000 level, which is crazy. All right, sorry, please continue.
Oh no, that's okay. So anyway, here, this is the area. This area here is this green count structure. So you can see that it attempts to upthrust this high right here on the point figure and then immediately fails right down to support. Supply is present. And then look at how it has no capacity to lift after that. It just sits there here and there's no demand. It just goes sideways and then fails into a new downtrend. And we have a count here that we can take across this area. And it gave us this count, which went to around 29.5. Don't hold me to that. You can check that yourself. 25,000. So that's the range of the count we got. Now, then we get another redistribution and look at the volatility start to increase, upthrusting action here, but look at all this volatility in here. These are not the characteristics necessarily of base building. And so if it had broken this upthrust and come down and shown an ability to maybe make a higher low or stay in this area and then start to have the volatility diminish again, that could have been accumulation, but it's not what it was. So we take this count. I tend to be very conservative in my distribution counting, and then I will look for bigger counts as we start to fulfill objectives. Now, what I do want to point out is I would take this count, and there's rules for how to take counts, but which are beyond the scope of what we can do today. But this is a larger count, which goes to your question about are bigger distributions are they important? Do they necessarily tell us that there's a bigger decline coming? And the answer is generally yes. And so here you can see, I didn't even count this, but this is a very, very large count. Now, I'm not saying it's going to do that, because right now, look at this. We are in the range of a fulfilled count, and look what's happening is that we are actually starting to see evidence of some kind of a cause building process. Now, this could be a cause for another decline. It's too early to tell. This is why we're technicians. This is why we're Wyckoffians, because we just read the tape. We sit there like monks and we just study, and then wait for that proper moment, because, and this goes back, because I know we're running out of time, but
no. You are the time. You are the clock.
Yeah, well, I'm
worry
gonna run
about
out of time. So, so here's accumulation schematics, and this is something I really want to emphasize. And again, go back and look at this blog and get these schematics in the blog, etc. Is here's where all the action is for a Wyckoffian, and this is fractal. You could be looking at intraday data. You could be looking at daily data, weekly data. You could be doing intraday point and figure. You could be doing longer term point and figure. Lots of ways to do this for counting purposes and creating objectives. But here's the thing, is that we watch very closely a market as it's proceeding to its conclusion of a causal. So a cause creates an effect. An accumulation cause creates an effect in an upward trajectory. A distribution cause creates a downward effect. And so we're always looking for the evidence of causes in the completion of causes. So here we phase C, phase D, we learn how to be able to identify these. I write about it. read it. Also, Wyckoff Associates, which is wyckofanalytics.com. My teaching partner, Ramon, teaches classes on the Wyckoff method. And so you can go check out his classes. He'll have a new series coming in the fall. And it's basically the Golden Gate University class that he's basically put on online, and he teaches it through his Wyckoff analytics. But anyway, phase C, phase D is the completion of accumulation and the emergence of a new uptrend. And so this is where we want to get busy. This is where we want to put capital to work, is when we believe that phase C, phase D is finished. And here's the thing, because stock is in strong hands, absorption has taken place, stocks move easily upward on low volume, and they're very difficult for large institutions to buy because there isn't enough stock to be bought. That's what absorption does. And so we are buying a fast moving market. The other thing is that short sellers oftentimes are still short over here, and they became a very important source of demand to drive prices up, especially when you get a breakout here. So we're training ourselves, steeling ourselves to buy these pullbacks in these fast markets, or being able to buy the breakouts as these markets are starting to emerge into new strength, because phase E is this massively beautiful large uptrend, and which we can approximate with point and figure analysis. So also over here, notice the volatility coming out of this market, schematic 2, how it becomes dull and quiet, goes into what we call a hinge, classical term from Wall Street 100 years ago, a hinge, and then it breaks out of that hinge and then boom, off to the races. So this is where we want to prepare ourselves to get busy and to act, because once this starts, the train's leaving the station and we want to be on it. And we want to think like composite operators. The difference between us and the composite operators, we have an advantage. And the advantage is that we're not trying to buy a whole bunch of shares. We're building a position, we're buying shares, but we're not buying institutional size quantities of shares where we need an accumulation to do it. And so we can get our position on relatively quickly. And so we can wait for the best moment. And Richard D. Wyckoff used to really emphasize that you do not want your capital idly in the market in stocks that are going nowhere. You either want to be in cash protecting your capital, or you want to be in a stock that's moving in your direction, and you want to find the best stocks that are moving the furthest, the fastest. And so therein lies the philosophy.
I love it. Here's a question for you. I understand that the Wyckoff schematics are typically best viewed through the lens of a point and figure chart, but I personally had a really hard time trying to figure out the best way to learn how to point and figure chart. And I see, on your prior slides, you had really nice point and figure schematics put there and doctored up, and I loved it. Do you use a certain software? Do you do that manually? How do you come up with your point and figure charting?
There's a number of good platforms that you can use for point and figure, and oh gosh, it's one that a number of people use. Traders.
Somebody in chat said stock charts.
Well, stock charts is where I do it.
Oh, okay.
So I also have a couple of other platforms that I work in that I have for a very long time. And so stock charts is very accessible. You don't have to have an account to make a point and figure. You do have to have an account to save them, but you have to put your chart in PowerPoint or someplace to be able to annotate it, because stock charts doesn't have an annotation tool for point and figure. But okay, you can create different kinds. If you have an account of stock charts, you can do intraday point and figure.
Well, let me ask you that. Oh, go ahead. Go ahead. Sorry.
No, just the point being that there, it's a good tool. It's a really good tool, and you have a lot of control over whether you're doing 1 box or 3 box reversal methods, and Stock Charts does it the right way. There are some point and figure platforms that don't do 1 box, construct them correctly for our purposes, and so those are all things to be considered. But let me also just make this one point, and that is that point and figure is really awkward for people. And we started out, Hank and I, teaching the Wyckoff class, and we actually devoted like the last quarter of the class to teaching point and figure. And we found that conceptually it was so difficult for people that we ended up doing point and figure as a second semester. And we added some other modules. It wasn't all point and figure, but it was mostly point and figure. And and we really developed, like, you know, our students had to know how to construct them. They had to learn how to be able to do them by hand. They had to do all these different things, but you know, when they were done, they could really do it. And so I write a lot about point and figure. Go check it out. Don't be discouraged if it's conceptually foreign and that it's odd, because point and figure uses a different methodology than vertical. Time is a variable in point and figure, and time is not a constant on the x-axis, and so that puzzles people. But here's the thing, point and figure actually kind of predates vertical charts. You can go back in time. They say that they used to trade rice, and they would plot their the trading in rice back, now this is 400 or 500 years ago, but with a point and figure method.
What?
And then I had many friends on the Pacific Coast Exchange making markets and options, and I would go down there and see them all the time, and all of them had these little cards that they would they were like trading cards or playing cards that they would hold in their hand. They had a stack of them, and each one of them was a stock that they were keeping track of on the floor, and they're standing there all day long through the whole trading day. They're doing point and figure charts. Those were all point and figure charts. They weren't doing verticals. And so point and figure is an age-old method. And then what they would do is they would take their point and figure, the cards that they did the point and figure in real time on the floor, they take it back to the office, and then they would transfer it over to a bigger chart at the end of the day. And so point figure is very historic. And I really believe that if you tackle point figure analysis, I'm speaking to everyone, that you'll be enriched by it. Here's the other thing. People don't do point figure because they get discouraged, or they think it's too complicated, or it takes too much work, or they have to annotate them or whatever. And that keeps people from doing it, which gives you an edge. If people won't do it, it gives you an edge, because you're doing something that most people won't do. And how many really good methodologies are there out there where you can calculate the potential extent of a move? And so let me just put this chart up. This is a gold chart. And so just as an example, so this is segmented point and figure. Look at this. It's a gigantic base, 2019 back to 2012. And these are the counts, GLD. But I only want to make the point that, look, here's segment 1 across here, the green one. And this segment, now you have to learn how to do segments, but this segment was really important because, look, it counted up to 192 to 202. That was the count range. You always want to estimate a range. And look where it went. It went right to 194. And then on a big climactic upward surge with a throwover of this 184 level, and then immediately failed back in. Now this chart's not up to date, but you can see here, this is December 31st, 2020. But you can see here the pullback after that. I mean, how many methods do we know that can give you objectives like that?
Right. Well, and remember my story earlier when I was trying to have that conversation about distribution, and the person I talked to said it couldn't be programmed, and his bots couldn't look for it, therefore it must be useless. So, like you said, if everyone could use it, it wouldn't work. That's how markets work. They evolve.
Yeah, and you know, I've known a lot of quant types, and I totally get it. You know, it's like I get what they're trying to do, and this is just the way their mind works. And I love all things market analysis. So, you know, we need them, and it's wonderful. But at the same time, I'm just like, I'm old school. I love it. Yeah, I think it's a unique. Like here, look at this, the semiconductor ETF. I do a lot of point figure on ETF. Look at this count across here, and look where it goes. And then look at this count, and it confirms. And I could have added these two columns here.
Yeah.
I tend to be very conservative when I count, but it would have taken me exactly up to this level, and I should have done it. But nonetheless, look what happened.
Yeah.
Fulfilled the count objective, and then on a somewhat of a climactic surge, had a big automatic reaction, range bound condition, up thrusting action. Oh, it's all distribution. What do you know? And here, look at how we're getting objectives from these prior structures. It's like, this is invaluable. Who doesn't want to know how to do this?
Right?
I'm
like
just
cheating.
saying. This is why this is so much fun. I've been doing this for like 40 years, and I'm still having as much fun as I ever did. So
Oh, that's great. That's
anyway,
great.
all right. So a couple more questions or comments or whatever, and then I will have to jump. But
Okay.
hey,
Okay.
we can do this again.
Awesome.
So
Hey, yeah, I'll take you up on
I love being with my people. You know, it's
well,
like
you're in good company here.
I know. It's just like we have like a room full of Wyckoffians, and it's just like, and even friends of Wyckoffians.
Yes.
You know, it's just the best. And so, I'm here. I want every one of you to be better at this than me. You know, that's what I've always said, and I'm not saying I'm great at it, but I've been doing it a long time, so I've learned a few things. But you know, it's like when we commit to that individually, it's like helping our friends and our comrades be as good or better than us. We're just going to get so good at this. And it's a philosophy, and just, you know, let's just all get better. You know, we're a small community.
I love it. I love it. Okay, so I have two questions for you, two and only two. Chat loved that, by the way. They blew up when you were saying that. So they absolutely will have you on again. We'll schedule it. If you have, you know, friends you want me to bring on, let me know, that kind of stuff. We'll plan it all out.
Sure. Yeah.
All right. So I have two very important questions. One is, okay, I would love to hear your follow up, your conclusion to that question of would a, you know, I guess the follow-up conclusion would be, is there a way to take a time in distribution and then look into the future and project what a future accumulation might go on to be? So if a distribution's 1 month, the accumulation's a year, is there any kind of ratio like that? So that's kind of my first question for you.
Sure. So kind of the traditional answer to that, and I have to think about a non-traditional answer, but is that point and figure can identify extent. It cannot identify the time it takes to do it.
Okay. So the target is what's important, and then you just picking up on the range being built is kind of the second half.
And then the other part of it, now that doesn't mean that you can't do other things to identify time and be able to parse time with cycle analysis and things like that. It's just that it's it's a different technique, that's all. And you know, I've studied, you know, lots on cycles and other things, and I don't know that I could you know, really use the size of a structure. All I know is that the bigger the structure, like this is just a swing trading structure that's goes back from September of 21 to February of 22, right? And so, and then by April it's over. But we had an 11-year uptrend in the markets, and let's see if I can find a chart of that. So here, and this is trend analysis. So this is something that Wyckoff did so well, was trend studies. And kind of my view is that, you know, I really focus on trends, and I focus on whether they continue to respect their uptrending stride, was the term that Wyckoff used, and stay in that stride. And look, this 2011. And I actually have a point and figure. I mean, not a point and figure, but an article. I encourage you to look at this. This is not really an answer to your question, so I apologize. But here are different long-term charts that I did using Wyckoff trend analysis. And I write articles. Some of my really early articles are on trend, how to construct trend. And so now, the MACD is such an interesting tool because you'll get a heuristic and a signal line, and crossing through, and look at the cross comes so close to the turn here. But what we had here was a throw over of the top of this. Mm-hmm. So we had a throw over and then a failure. And I pointed out that when you get, this is a definition of overbought and a throw over, and I have point and figure counts in here, is that when you get a turn off of that, oftentimes within the channel, the decline from the top to the bottom can be quite rapid. And so it's a point of pretty significant risk. Example here is the Dow. This is again 2011 to the top. This throw over. Look at this throw over here. This is exhaustion, a test, pretty sharp break, another test, and then look at that. That's the COVID. Mm-hmm. And so here, look at this, top to the bottom, very volatile. And you can go look at these. And by the way, these indices are now at or near the bottom of their channels. So they're by definition now in an oversold position. Could throw under, but you know, likely even if they throw under, to have an attempt to bounce at support. But, and here's NASDAQ to S&P. Look at this big distributional top in relative strength. And my view, kind of as was the case in 2000, is that the growth stock theme had a climactic blow off into the end of 2020, and then has been failing on a relative strength basis. And look at this decline. And I think this decline may be even all the way down into the bottom of the channel. I meant to update this, but I didn't have time.
It's okay.
For
next time. That's for next time.
But trend analysis. And so, you know, and you can do trend analysis intraday, daily. In this case, it's weekly. But these are charts that go back, you know, 6 to 10, 12 years. And I love this stuff. And here's the NDX back to 2010. Classic construct. These 3 points right here. This is the way Wyckoff did it. He said that the stride would form very early in the uptrend. And he says, take 2 adjacent lows, extend the trend line. Look at this. And then the intervening high, draw a parallel. And look at how it contained this advance for all that time. That's just amazing. And so, and then look at this massive throw over here. This is a huge overbought condition. that concluded an advance that went on for a very long time. And this is why we are trend followers, tape readers, because we wait and let the market tell us what its intentions are. So, and then this is put call data. So this is extreme call buying up here, right here, extreme optimism. And here's extreme put buying, which is bullish at the 2009 Great Recession lows. So huge put buying at the lows, huge call buying at the top.
Interesting.
So, and you had expressed that you were looking at some other sentiment type work. And a lot of that is just really exceptional, valuable work. So just some cool stuff, and you can go look at this. Yeah.
I love it.
Get this out of the way. And then I don't know, was there something else I was gonna, anyway, so.
Well, I know, so a lot of my audience, they have heard me harp about the video you put out a few months ago, talking about the Dow Jones between 1917 and 1921 and the similarities and structure between the Dow Jones today with the initial sell-off, which we could relate to March 2020. And then the bull run, which is, relatable to 2020 and 2021. And then the subsequent bear market or downtrend that occurred in the later years, which we could relate then to 2022 and present. So I know a lot of these audience members are curious if you have any kind of update. I know the first, Dow Jones hitting 30,000, that was the first target. Hey, we hit. So I know a lot of people are kind of on the edge of their seats saying, what's next? What now?
Well, see, what can we do here? I didn't bring those studies, but I did do it's called Your Daily 5. It's at Stock Charts, and it's like a 15-minute little video vignette. And I did it a couple months ago, and it was Anatomy of a Bear Market. And what I did is I did 3 bear markets and compared them. And I did 73, 74. I think I did 2000 to 03, and then I did the Great Recession, 06 to 09, 10, 11. And I believe those are the 3, and I lined them up against each other, and then I compared them to today. And so I would heartily encourage people to go check those out. Yeah,
I would be interested in seeing that. I think that's important. In fact, last stream, so this is Sunday for me.
Oh, here we go.
Did you find it good? So last stream, I went and compared oil to the 2008, 2009 time frame, and then compared that to what we're seeing today and how its relationship is with distribution within the markets. It was very interesting to compare those two periods.
That's such a good thing to do. And kind of my little stupid story. Now, this is called Your Daily 5. Go to Stock Charts TV and go to shows, and you'll see a tile that says Your Daily 5. And then it's all by date. So this was May 24th. And so Anatomy of a Bear. And I believe this is the one where I lined up the bears and compared them to where this market was. And so I would heartily encourage you to go check that out. And that's a good one. And you can go link to that if you want to send that out to people, but or give them a way to get at that. But do that kind of analysis. It's just really, and sometimes just do simple line charts and just compare, and you'll see that there's similarities and differences to all of them. And I could go on and on about the current structure, and I'll show one chart here in a minute, but this chart is really cool. And this is a different kind of scaling for point and figure. Instead of like price, like 50-point scaling or whatever, we're doing percent. So this is a logarithmic scale. Each one of these is 3% higher than the prior, the lower. and then it's one box method. So you just the way you construct it. And all I did was I just went back to 2011 and I evaluated this uptrend with point and figure. And notice, this is really important. Notice the long periods of time in uptrends where the market is effectively trendless. And so trendless market marks up and then fulfill, and then you get a count. You fulfill the count, go into another trendless period. Look at this, 2014 to 2016. You got to have patience for these things. And it just grinds it out, builds another reaccumulation. Reaccumulation is something I spent a lot of time on. And so maybe that's something we can talk about next time. But here you can see another count. Look at this, goes up. And so here it looks like the count didn't work. And then it goes again and finally up thrusts into this count zone, which confirms this count right here, this blue one. Two counts meet each other at this level, and then you get a bigger correction, which is the COVID decline. Big accumulation structure or reaccumulation, however you want to think of it. And then look at this count, and it goes right up to this level here, which is August of 21. And then this is my Frankenstein chart because I piece parts it together.
Oh, I see. You got it.
Yeah. So here's what ultimately happened. And so we have then I put this on just for you all so that you could see this is up to date actually. So you can see this is how much the market is corrected, but look at the distribution here. Now let's take a count. We do the count. Look, we've gotten within one box on a 3% scale of fulfilling this down count. Maybe we can get down there at 36.18 and fulfill this count with additional weakness. Maybe this is it. I don't know. But look at look at this beautiful uptrend, which you can draw on point figure. Look at the throwover. And then it just goes sideways out of the uptrending stride, has one last attempt to test these, and then just falls apart. And this chart is a one box swing trading method using standard scaling. This is 50-point scaling. And look at these. You can do these little swing trading counts. Look at how nicely they work here. And this is the big trading range redistribution, which we could spend hours talking about, but we won't today. But then down it goes, fulfills that count. This number is not up to date. I think that's through June 13th. And then here we go, well, there's a bigger count out there. This is a bigger structure. So is it possible that this count is these little counts are part of a bigger count? And then this gives us a count to 2950 to 3250. So now, do we get there? I have no idea. But the thing I would say is again, you just have to be a good, you've got to be a good trend follower and tape reader. And I had one chart here that might help us with this, if I can find it. And I just put all these charts in.
I love it. I love it. Chat loves it.
Well, because when I do a presentation, I know where I'm going. But I know that when I get on with Jack, we could go anywhere.
That's right.
It's like herding cats, right? It's like we go any direction. So anyway, and so I just figured I'd better have one of everything. Anyway, here, this is the NASDAQ composite. Here's the NASDAQ index. This is this percent of stocks in the NASDAQ composite that are above their 50-day moving average. Simple concept. If you're below your 50-day, you're in a downtrend. If you're above your 50-day, you're in an uptrend. And the individual stock. And so what it does is just keeps an aggregate count of all those. And so this is the January to March decline here. Notice the volatility starting to come out of this, even though it's like got a slight decline going. This last decline doesn't even get to a new low, but this is a downside non-confirmation because each of these lows shows that there's fewer, I want to say this exactly right, there are fewer stocks below their 50-day moving average, which is a sign of improving breadth, internal. And I love these kind of internal indicators, advanced decline, stocks above their 50, stocks above their 200, and so on.
Mm-hmm.
And notice how this gave us an advance clue that this was in fact a form of accumulation that resulted in a rally. And this is the best rally of the year so far, by the way. And in a bad year, but so slightly up thrusts and then fails, big decline here. But kind of what's happening now, I don't know if this is going to result in the same kind of a rally we had here or something different, but it's so far it's been helpful because I'm saying that the May low, second week of May, that's the internal low, the breadth low in the market. And this is one of the reasons, there are others, but look at, this is after this long extended decline. And this low then is followed by a lower low in the NASDAQ comp, has a downside non-confirmation, so a higher low, while this is making a lower low, which is showing an attempt of the internal stocks in the composite trying to heal themselves a little bit. And also, I would just like to point out that this is a really good rally, even though it didn't show up in the comp, it showed up here. So that was a pretty good advance, then a higher low, and then look at this advance. These are both better than what we had over here. And so now there's an attempt to go down. We had a horrific CPI number. And the market, the NASDAQ responded by, I think, basically being unchanged today. Opened weak, but the CO types and the trader types had seen that all this CPI stuff was already discounted into the market, and they knew it was going to be a relatively bad number, and it was a little worse than expected. And this is the response the market gave for that. Now, PPI comes, I think, tomorrow, so PPI could be even worse, and maybe the market just falls apart on that because we are near the lows. But this might be some kind of a cost building process that has more time to spend over here. And this is a bit encouraging. I'm saying this is a bear market. I'm not calling for people to try to trade it on the upside or anything. I think people should just protect capital and watch and pay attention. But these are the kinds of things we do to entertain ourselves in a bear market.
Exactly.
So and learn from these things. Yeah. So anyway, there's that, and they have this tool for, you can look at it for the New York comp, you can look at it for the NASDAQ 100. I mean, there's a lot of ways that you can slice and dice this, but that are really good. And then the only other thing that I really, I mean, you know, I could go all day and all night, so you got to just stop me. But this is a point and figure chart that I originally did of the crude oil back in January of 21, and basically was saying, okay, we build a cause for an important advance. I think point figure on crude oil works really, really well. I've taken point figure back decades on crude, and it's pretty good stuff. It works quite well. So look at this beautiful count. And remember how crude oil went negative?
Right. Oh,
can you imagine? Look, -3.
No,
-304.
shot. You'd be
Yeah,
thrown out of the
yeah,
room if like back at, the 70 range. If you said, "Hey, look,
yeah,
-3 coming up, big, get
yeah,
out,
yeah.
get out."
Anyway, so yeah, thank you for that. I like getting thrown out of places. Anyway, so so the so this chart is crude oil, and this is a bigger count. So what I did, I adjusted this. It's 92 to 112. We only spent 3 trading days going above this 112 level to 130 on a climactic blow off. Immediately fell back in, and and we've been in a trading range ever since. Well, and I'm going to go really fast here. Here's the 112 and the 92. I shaded that area, and look at how this count, even though it threw over the top in a buying climax, it contained most of the trading of crude oil ever since. And now look at this potential distribution structure with an upthrust and a fail back into the structure, and look at the volatility coming in with volume as it's going down. And I'm only putting this out there as an idea. What if this is distribution and that we're going to get more weakness out of this area? Maybe not right away, but maybe we could go down to the bottom of this channel, or heaven only knows. But I think this is just fascinating.
I
And
love it.
yeah, so different. But here's point and figure, and Wyckoff analysis giving us a different way to look at this. And if we just don't think about what it is, and so my question to everyone is, putting my business cycle hat on, because the last bull market you get in a business cycle bull run, which lasts 4, 5, 6, 10 years, is the last market to move up is inflation, commodities.
Yeah.
So bonds top out first, stocks top out second, inflation beneficiaries top out third. And is that not what we just had? And so is it possible? I don't know, but I just let the charts tell me where they want to go. And this is a remarkable sign of weakness, this decline down towards support. And so we'll probably catch support, rally some. I'll be very curious about the quality of the rally. And the companion chart to this is here. So this is a point and figure of part of the structure, and it counts down to 88. But what if you take the whole thing? This is a substantially larger structure, but I'm just taking the little swing counts, and look how nicely they're working. And then here, gasoline's a scary business, and this chart goes back 21 back to 2014. Huge causal structure. Here's a smaller one. Here's 2 count objectives. Scares me to even think about the possibility this could happen. But let's just go to the swing counts. So, and the question I know you're all asking yourself this question. Well, if crude oil and gasoline are backing off of their high prices, does this mean we could get moderation in CPI in the months ahead? Maybe not right away, maybe not next month, but out in the future, and maybe it'll show up as lower prices at the pump, hopefully for everyone's sake. But that, I know you're asking that question, whether CPI could moderate. Well, and the other part of it is that these big traders are already have discounted this into their thinking. So here is 2 accumulation structures in gasoline, and this is price per gallon wholesale futures market. So 320, 345, and here 430 to 480. Look where we went. We went right to 430, hit the minimum count objective, and we didn't get up to the higher count, which may have been evidence of some kind of internal weakness. Now we're down to 312, and I'll show you an updated chart. Here's the base accumulation structure here, lower right, yellow shading, and look, this count with its central tendency of 450 and a high of 520 matches the count, bigger, obviously much wider count structure, but this confirms the count that's in green here. So we call that a stepping stone confirming count. And so these two counts confirm, which often when you get that kind of confirmation, it's like a double evidence of the end of an uptrend.
Okay,
And then
I like
here, yeah, so here is just the vertical, and it's the last chart that I'll torture you all with. But oh, I have one more. Anyway, but here, look, up thrust after distribution, go read about that, because this, note the up thrusting action of the buying climax in gasoline, and comes with a test, which you would expect, and look at the gap. So that gap is a huge clue, and then it cascades back down into the trading range structure, is now in the lower part of it. Maybe it gets down to support, maybe it's got to do more of a rally, we'll see. But gas has come over $1 off of its high watermark for this advance. And so the question again comes back to the idea of CPI, PPI, and whether or not those can be positively affected. Eventually, it could take months for this to flow through, but there, you know, that the really smart Wall Street people are already discounting this potential into their analysis.
Agreed. Or looking for a rally with which to use to exit their positions, which would only apply more downward pressure. In either case, yeah.
All right, so last one is, this is the CPI, the big story today. I really tweaked a lot of people with this chart, because they said you can't do point figure analysis on consumer price index.
Whoa.
And which just made me happy that I could upset so many people. And, but at the time, I put this count objective across here in yellow, and I did two segments. The yellow segment over here gave us a count that goes 8 1/4 CPI. And this account line's at 2. This is in a CPI of 2 across here. And this is going back to the year 2000. So I made this a very large structure. I wanted to be able to count a very large structure. And so there's techniques for doing that. We could talk about that in the future. But anyway, so here, 8 1/4 up to 1188 was our count range, with a central tendency of 1075. And people were like, it can't go there. It's impossible. This is a transitory. It's going to pull back.
Yes.
Yeah, remember that? Yeah.
Yeah, I listened to that for 6 months.
Yeah. It's just like, and so now, and look at the hinge here. Gigantic hinge, higher lows, lower highs. This is the taking the volatility out of the accumulation structure. It's what accumulation does, right? And somebody pointed out to me, one of my friends, it said, well, you know, everything that's in the CPI is something you can trade. So it's really like an index. It's an index of prices that are all brought together. So it's like, sure, yes, of course you can count a CPI like you could a stock chart. And so look where we are, 910, and we are in the count range. And please, for all of our sakes, yeah, please, for all of our sakes, let's have this be the end of it. Yeah. Somewhere in here. And because it's really painful for a lot of people, and for all of us, savers, people that are on incomes, fixed incomes, etc. So let's hope for this. And I like to hope. They say don't ever hope in the markets, but there's certain things I want to hope for. So anyway, all right. With that, you guys are all wonderful, and I appreciate being with my people.
Well, you definitely are. This has been something we've kind of talked about and joked about, you know, having you on. Never thinking it would actually happen, but we're so thrilled and glad you are. This has been really, really fun for somebody like me, where I'm talking, It's basically a greenhorn, but about these really advanced concepts. So it's awesome to have an expert come in, a professional, and talk it through with us. Bruce, do
Well,
you want to? Is there anything you want to shill? Like share some of your socials, and I've been doing it off and on, but plug anything you want to plug right here.
the only thing I can say is uh, my Twitter, which I've got to. Jack's going to teach me how to tweet and teach me how to create compelling tweets. Anyway, but it's at RD Wyckoff, WYCKOFF. And so that's my tweet handle. And then every Wednesday, so look for this. I'll announce it on my Twitter feed, but about once a quarter, we do a free Wyckoff market discussion. And every week on Wednesdays, Ramon and I do a weekly Wyckoff market discussion, cover all the major markets and look at stocks and so on. And so we have a great following for that. And so check out the next. Oh, and also you can go to wyckoffanalytics.com and you can stream the last one we did, the free one. And also there's a ton of free content on there from other great Wyckoffians that are in our community. And so go get the free content. Go see my blog, written blogs at Stock Charts, and it's called Wyckoff Power Charting. And then also I do, and it's not behind a paywall, and I also do a video series for power charting, for stock charts called Power Charting. It's a weekly show, comes out at 1:30 Eastern on Stock Charts TV, and then goes to on demand. That's all free. And I've got about 2-3 years of stuff there, which, just check out some of the latest stuff, because I talk a lot about distribution and the unfolding of distribution in the last, really since about September. And so go check that stuff out. And then go look at the older titles, because I do workshops from time to time. And, but that's all free stuff. I did that for us. I did it for our community. So, because I want you all to be so good at this. So
That's great. I love it. I
yeah,
love it. And everything I do as well, there's zero paywalls or anything. People
good.
can do little, like I was saying, little $5 donations or whatever, but nothing behind a paywall. So, but yeah,
And also over here is a ticker tape, and the term that Richard Wyckoff used for a value. Literally, you can take Wyckoff down to bar by bar and volume analysis, and look at spread and volume and evaluate every single bar and take it up to these big structures that we looked at, and everything in between, and look at the accumulation structures, distribution structures. We didn't even talk about reaccumulation, which is hugely valuable, but and then everything in between. And so he called it being a tape reader. His idea of reading the tape was not to read the ticker tape here and look at the quotes, because this is how you used to get the live quotes back 100 years ago. But he called it tape reading, but it was converting the prices on the tape into these beautiful charts that we evaluate. And I've been doing this chart work for 40 years, and it just makes me so happy. And I'm very grateful to all of you to allow me the time to be able to show you some of this work today. So I really do mean that, because I know how much we all love this stuff.
yeah, this is great. This is great. I love it. Well, Bruce, thank you so much, guys. Check out all of Bruce's stuff. He listed it. I know the mods have been spamming it. As we had different discussions, I would link different things. So be sure to check all that out. We'll put this up on YouTube here before too long. We'll share that out. Bruce, I'll share that with you as well.
Did we keep it under a half an hour?
Yeah, barely, just a little over a half hour. It's okay.
Okay, good. So we're on time.
Just barely. Yeah. We did great. We did great.
That's why they won't let me run a railroad.
No, this is great. This, like I said, you are the time. So there's no late, there's no early, there's only Bruce. And
But we get to do it again, right?
Absolutely. We'll do it
Okay.
again. We'll make a date of it. You got it.
Thank you all. Thank you, Jack.
You bet.
And we'll see you again.
All right. Take care. See you later.
Bye for now.
I'm not trying to be perma bull jack, perma bear jack, just charts jack. Just whatever the charts are telling you, that is all I'm good for. That's all I'm here for. And nothing else. I'm not your hype man. You know, I'm not your bear guy telling you to sell.